Good afternoon, ladies and gentlemen. It's a pleasure to be with you this afternoon. I don't have any slides, as usual. I will tell you some stories about the global economy and what it means for many governments around the world, and where we are heading in terms of economic outlooks around the world, so that you can have a little bit of idea what is out there ahead of us. And when you're dealing with different issues of public finance, this few stories will help you, I think, understand sometimes some of the money flows and how things shape up in terms of economics, business, and ultimately government governance as well. Now, you have all noticed that in the last 35 years, approximately, we have had more economic crises than in the 350 years before that. The frequency of crisis has accelerated. It's enormous ups and downs that we see. And interestingly enough, in 2008, 2009, we had, in absolute terms, in real money, the biggest economic crisis the world has ever seen, happening at a time when we have more knowledge about economics and business than ever in human history. Unbelievable. In the last 8 years, we had two of the biggest commodity price booms and busts ever recorded in terms of highs and lows, and all the implications it had had on markets in Latin America, in Russia, CIS, Africa, Middle East, as commodity prices go down. That kind of volatility that we see in developing markets related to commodity prices, we see quite a few things happening, of course, in the United States. Look at the outcome of the presidential elections. How many people feel left behind? In Europe, the rise of far left, far right, Brexit happening. All of those things are showing us there's something is failing with economic policies around the world. It is a failure of economics in many ways. It has been hijacked by mathematicians, people forgetting that economics, at least 50%, is about people and psychology. And in the end, everything looks very different at the moment. And I often think about Renaissance Florence, where they used to talk about something called il bel comune, which is kind of a good society. And it reminds me of some very smart economic history, which always said, if we do anything about economic policy, it should always, whatever we do, whatever economic policy we implement, it should be equally beneficial for an individual and for a society. If you allow to go too far, benefiting just society and ignoring the individual, we know how that ended in Eastern Europe and in other socialist-driven markets. But on the other hand, if you allow a small group of individuals to be the sole beneficiaries of some of the big globalization trends, ignoring the societies, and allowing in 2012 and 14 and 2015 that the youth unemployment in Spain or in Greece goes to 60%. This is a complete failure of economics, and it needs to be rethought completely from its fundamentals. So what we're having today, and I need to step back a little bit. If you look at 2009, big crisis, as I said, but you all know what happened before that. A small group of people in the financial circles created the biggest global credit bubble ever recorded on the planet Earth. And of course, we were all enjoying that period of time when times were good in terms of business growth and economic growth, but it was not sustainable. It was abnormal. And we all know how that bubble was created. Just look at the Big Short movie. That's the only thing that you need to look at. Then you'll understand what was rolling behind the hill and how nobody was regulating any of that stuff. So in 2009, we had that big cataclysmic event, global recession, many markets going down. And then I need to remind you of the policies implemented here against that decline. In the United States, Ben Bernanke at the time, the chairman of the Federal Reserve, did something right. As a scholar of the Great Depression, he knew we had to do something proactively. We could not be doing the same thing as 1929, when, as you recall, 1929 to 1932, nothing was done when the US was facing a Great Depression. The mantra was, well, markets will self-correct. Well, as we all know, by the time they self-correct, we can all be dead. And of course, that's not applicable in today's world. So what the United States did, and I remind you, between 2010 and 2014, proactively tried to reflate the American economy and get it back to growth. $4.5 trillion US dollars were printed in the extra monetary emission, which they never said we are printing money, but they said we are calling it quantitative easing this time. We don't want to scare anybody on the planet Earth. And an interesting thing developed. The idea was half of that money ended up for various fiscal stimulus measures. Whenever Barack Obama needed some money, he didn't have to go to the open capital markets, but he would go straight to the central bank, give them government bonds, and he would receive freshly printed dollars, and with that he was able to go and build motorways in North Carolina and hire people to do that. That's a good way to reflate economic growth, which at the time was facing a depression. What people don't realize is that about half of that printed money ended up in financial institutions, cleaning their balance sheets, which were full of garbage liabilities. You all remember those stories of AAA rated securities. And the idea was, you as a financial institution, you give us your garbage liabilities, we'll give you freshly printed dollars, and then you can lend to Joe Smith in Alabama for his small and medium-sized business. That was the idea. But the financial industry had something else in mind, and I will come to this in a moment. In the UK, they printed more than £1 trillion, and this ongoing program is still there, especially now after the Brexit vote. And in Japan, in the last 2 years, they more than doubled their money supply, trying to escape out of deflation. So there's a lot of money printing that's been happening in a lot of key economies around the world. Europe didn't do that because in the ECB charter, there is no provision, or it's not allowed, for the central bank to buy government bonds. So Europe was for a number of years lagging behind. And I will come to this in a moment. Going back to that money printed and given to the financial industry in the US and the UK. This, by the way, the next points have huge implications on a number of markets around the world in terms of availability of finance for them, availability of how much money they can have to provide for public services, and so forth. So instead of lending to Joe Smith in Alabama, what some of these financial institutions did, they started two major parties around the world. The one was, let's look at what's going to give us high yield today, and because we think Joe Smith is a risky customer, maybe he'll be hit by a bus tomorrow and the returns on him will be small. But we can buy the Turkish government bonds and we can make 14% yield, and we can buy the South African treasury bills and that will give us another 12% yield. And we can buy some government other securities or equities, whatever is going up in value in developing markets or where there are high yields. This is where we are going to allocate our money. So in 2010, we had the beginning of a major party of inflows of cash going into emerging markets in particular. And you all know what that meant. You know, there are some of you coming here from Africa and some other nations, Latin America. It's being streamed to all the members around the world. You all know what happened during that time, 2010 and 2014. Unprecedented inflows of freshly printed money, what commentators were referring to as the wall of money, going from freshly printed developed world cash, going into emerging markets assets, inflating the values of their currencies, allowing all these markets to have easy access to finance. Governments were easily able to raise money during that time at record low costs. Suddenly everybody felt richer. Imports were basically cheap suddenly. They were importing a lot of products and so on. It was a good period for business, good period for economic growth, easy times, relatively speaking, for governments to access cash. And then what happened was Ben Bernanke suddenly in 2013-14 was saying, well, we should think about stopping this money printing program. And that's when this sort of panic started to settle in, and many of the big funds, JP Morgans of the world and so on, started to take the money out again of emerging markets in panic. In 2015, the panic reached its culmination, and what happened is the first negative outflow of portfolio capital from emerging markets since 1988. Unbelievable numbers, since 1988. And what that meant, again, as money was leaving in panic Imagine one of us in this big room decides to leave this room, and everybody else wants to leave at the same time through the same door. There'll be losers in the game, in the panic outflow. And that's what happened. And that you can imagine what it did to many currencies and government finances around the world, especially countries that are relying on commodity exports. Brazilian real fell significant double-digit depreciation. South African rand went from 6.7 to 17, would you believe? Mega outflows of capital happened at the same time. And suddenly, governments could not access any finance anymore because nobody would want to buy their government bonds or treasury bills, or they were demanding such high premiums that not a single government was able to raise the money at a reasonable amount or at a reasonable premium. And we are going, ladies and gentlemen, through these waves because nobody is controlling any capital inflows and outflows. Back in the early 1990s, I remember I live in Vienna, Austrian central bank at the time had shillings, and that was the currency. And only then, in the early 1990s, Austria, together with many other members of the European Union, decided that it was a good time to liberalize the capital account so that anybody can start buying Austrian government bonds or treasury bills and so on. So they only did it 45, 50 years after the Second World War, when GDP per capita was almost 25,000 euros at the time, or dollars, whatever the numbers were, but rich countries. Today, what we are doing to developing markets is we are forcing them to open up the capital accounts in the name of free markets and globalization and liberalization. And you and I, after this session, can go out and buy any government bond on the planet Earth, and we can then decide to sell it the day later. China is the only one, by the way, keeping capital control still. And if you want to buy renminbi, they will ask you why, and will you build a factory in China? And if you don't, you will not be able to buy renminbi for fun and speculation. And so we have this massive problem, what nobody is debating significantly, where money comes and goes, as it will. Big financial institutions are playing the game. They have convinced the IMF and the World Bank, and they are playing the game as well, of telling all the governments around the world you should open up your short-term capital account. And I don't think anything will change with this. So if you're representing different governments around the world, you will know, and you will see in the next 5 years, 10 years, 15, 20 years, you will have these episodes when financial community gets very enthusiastic about buying government bonds around the world, particularly in developing markets. And they do this for several years. And then they all get very depressed and they all leave. And then the governments cannot find any finance. This is the kind of volatility that we will still face for many years to come. And nobody is trying to change this at the moment, which is an absolute economic tragedy if you think about it, because it's very hard to run an economic policy if you have these massive inflows and then massive outflows. The second party that was started with that freshly printed money, ending up in financial institutions, they also started to buy futures of various commodities. And that's an interesting story, because today, actually since about 2004, 2005, the pricing of commodities has shifted away from the physical markets that we touch and use to the futures market, which has become nothing but a big gambling casino. And again, run by some of the largest financial institutions in the world. That's where this is happening. Now, how does that work? If I give you the example of oil, 50% of all commodity trading in the world is oil. And strangely enough, when oil price goes up, metals prices go up, and agro-commodities go up. When oil goes down, others fall as well. Strange enough, simply because the big funds are lumping all commodities together and playing the paper game. Now, how does that work? Just to give you one number, and you'll be astonished. If you think about oil futures, and you think, okay, well, the futures were invented for a good reason. You can hedge against perhaps rising prices in the future, and you buy an oil futures contract and you protect yourself. It was designed with a good purpose. Today, it's completely being misused. Totally. Today, 97.3% of all oil futures trading transactions do not result in a trader taking the physical possession of a commodity. So only less than 3% of all futures trading actually is linked to the real need for oil, or for copper, or for wheat, or corn, or anything else. So the traders, when they're in a good mood, and usually using some drugs and substances, as you can imagine, if the supply of cocaine is very good from Latin America to the trading floors, they all get very enthusiastic and optimistic about trading and higher rising prices, and they all bet that oil price will rise or copper futures will rise and so on. And then as they bet that they will rise, the prices actually do rise. If the supply of the drug substances is low, they all get depressed. And you know the movie The Wolf of Wall Street, and you know what kind of characters we're talking about. But you are basically talking about, in the end, panic sell-off in the commodity markets. And this is why oil price can go from 115 to the dollar to 28 in a matter of a few weeks. Because it has nothing to do with the physical supply and demand. Again, nobody is controlling that industry at all. The last time somebody from regulating industry visited any of these trading floors on the commodity side was back 8-9 years ago. It's a disaster because nobody is even looking at what does that mean for countries that are so dependent on exporting commodities. Most of Latin America, 60 to 80% of their exports are commodity related. The moment commodity prices go down, they are suffering. Governments have no money. They have to go and beg financial institutions to borrow actually some cash to be able to pay the basic services. Suddenly, it's an economic crisis. Russia, CIS, 70, 80% of their exports are related to commodities. Middle East, not even to mention that. You know, over 90% of exports are commodity driven. Africa, most countries export 1 or 2 or 3 commodities. That's another, by the way, failure of economic development as well. When we are living in the world where such big chunks of the planet Earth are unable to produce anything of high value added, which is a major failure of economic development as well. And this is, by the way, something that is also a major topic. I'm not going to go into this now, but just to highlight this. When South Korea, back in the 1970s, which was a poor agricultural society at the time, said we would like, they were talking to the World Bank at the time, and they said, we would like to build a steel plant. And the World Bank wrote a letter back saying, we think you should stick with what you do best, which is agriculture. This kind of advice is still pervasive. And this is what the big multilateral, bilateral institutions are still saying and arguing with developing markets and say you should stick with what you do best, which is the extraction of copper in Chile or whatever it is, instead of telling them how the world got rich in the first place. And we all know the story there. You know, stealing technology from each other, protecting markets, all of the stuff that actually some of the right-wing politicians are talking about today, which is a funny twist of developments there. But this is another topic, and so many countries remain impoverished because they have not been given a proper advice how to develop. And very few, in fact, have been catching up with the developed world. South Korea is an example, Taiwan is an example, and we all know that China is ignoring all of that advice as well coming from the West. And they're doing exactly what Korea did and what Taiwan did and adding an additional twist to it as well. So keep that in mind, that we will have these 2 mega volatilities still happening in the future. Inflows of cash going into developing markets on the wave of enthusiasm and then leaving in panic. And then we will have the wave of enthusiasm about commodity prices, and then again everybody will withdraw. After a while, they will all be going back in. What that means for the availability of government financing is absolutely critical point. Because during the good times, the access to finance is good and cheap, and governments are able to do something. But then many governments are not ready for what comes next, which is when the outflow happens. Most have no idea what to do. And in fact, they make mistakes. If you look at the Brazilian response to the outflow of money and the fall in commodity prices, it was a disastrous response overall. Because what you should be doing is to start a bit of printing money, like the West is doing. You should be cutting interest rates very low to get the growth going. Provide the fiscal stimulus program. They did exactly the opposite. Cutting spending, increasing interest rates, and pushing the economy further into a debt spiral and a significant biggest depression that Brazil has been going through in over 80 years. So the response often is misleading and bad. So keep that in mind, especially for businesses in emerging markets. These two issues will be pervasive for many, many years to come, and nothing will change that. And this is how the money financing and everything will be available or not available, or very expensive or very cheap for a while. That volatility will stay with us. Now, how the market's doing around the world very quickly, and then I'll come to some of the developed market issues in Europe in particular. Many of you obviously interested in the European markets. But in the developing markets, just quickly, Latin America struggling at the moment. We don't see a major inflow of money going back in. Commodity prices are still low. Growth is non-existent. Very tough environment. Russia, CIS, the same. Most markets still in a shallow recession. Difficult environment. They're all struggling with significant budget deficit issues like in Latin America. Middle East, major problems with budget deficits at the moment everywhere. Public debt's rising across the board. They're all trying to borrow internationally to plug the gaps at this stage. Africa, devastated at the moment in a sense of low commodity prices, outflow of funds, and all of them are struggling to make ends meet as governments. Very difficult environment. And then even you have in the developed markets some of those affected by these inflows and outflows. Australia, 80% of exports are roughly commodities, roughly speaking. New Zealand, partly reliant on it. Canada, very much reliant on oil and gas exports. You have Malaysia, Indonesia in emerging Asia as well dependent on it. So these markets that are commodity driven at the moment are all down and struggling. The others are not doing so badly. The rest of emerging Asia is growing 6% a year at this stage, led by India, still China. Philippines are doing 6%, Vietnam 6%, Malaysia rising as well, around 4%. Finally, Thailand is now coming close to 3.5–4% growth. Emerging Asia is the fastest growing part of the planet Earth and will be for many years to come. It also has the best government finances, by the way, that emerging Asian part of the planet Earth. It has very low public debt compared to the European Union or the United States or, God forbid, Japan. All of those basically markets across Asia are very fundamentally solid in terms of their government finances and will not have major problems going forward. Central European markets as well, and to finish the story on the developing markets, Central European markets are doing okay now. They're growing around 3%, which is, as you know, about double the rate of the Western European growth. It's actually quite good. And in fact, these markets are not dependent on exporting commodities. They're mostly selling, in fact, high value-added products, huge inflows of foreign investment we have seen in that part of the world in the last 20 years. And so they have something of value to sell to the rest of the world. And in fact, they're enjoying a solid economic period at the moment. And none of them have significant issues in terms of public debt or big budget deficits. And in fact, they have the easiest access to finance in about 8 or 9 years, considering very low interest rates at the moment and the relative interest of the financial community to buy various government bonds of Central European markets. Then we come to the developed world, and we have two major issues that I would like to talk about. One is what's going on with Western Europe and the European Union and in fact, the Eurozone itself. And then the impact of the Trump presidency on the United States, but also perhaps on some of the other developments around the world, as far as we can tell at the moment, because nobody really knows what the new president will do, and I guess he doesn't know either. I would imagine. Oh, by the way, all that I can think of when I think of Donald Trump is some jokes around him, and but I'm not sure if I should say this because I'm being streamed around the world. Do you know what's the difference between God and Donald Trump? God doesn't think he's Donald Trump. And Bill Maher, by the way, who is the US stand-up comedian, he said, I knew this was always going to be a tight race. On one side, a hysterical woman, and on the other side, Hillary Clinton. Interesting one. Yeah, let's look at Europe, and then I'll go to the US and close with that and then take some questions. The European Union, as you know, for 6 years could not do anything in terms of reflating the European growth. while the US Federal Reserve, the Bank of England, the Bank of Japan were all printing money and reflating growth into those markets, Europe wasn't able to do so. The charter of the ECB did not allow any of it. And then, as you know, in March 2015, finally, after many, many years of debates, they found a loophole in the ECB charter to say, okay, let's do something proactive, which will not breach the rules. Maybe it will make some people in Germany angry, but we will still go ahead and do it. And the idea was, we are not going to buy government bonds that are newly issued, but we will go to commercial banks, Unicredit, Societe Generale, and the others, and say to Unicredit in Milano, hey, you're holding government bonds of Italy. We would like to buy those bonds from you now as ECB. You give us the bonds, we'll give you freshly printed euros, and you will lend the money to Giovanni in Firenze for his small and medium-sized business. And then later on, as you know, this was expanded to buying corporate bonds as well. At the moment, this program is still running, 80 billion euros a month running, sizable, I would say, compared, well, certainly to the US and the Japanese program, perhaps not as sizable, but in absolute amounts, we have printed now more than 1 trillion euros, and the program will probably run all the way to March 2017, and could be even extended all the way to the end of 2017 as well. Now, why is this significant that suddenly the ECB is doing all of that money printing and the quantitative easing program? The impact on European growth and the economies and on the government finances, and by the way, the Eurozone is problematic with public debt, as you know. Over 90% of GDP is public debt in the Eurozone. It's huge. Well, not as huge as Japan, 240% of GDP over there. Only, by the way, Zimbabwe and St. Kitts and Nevis have more public debt than Japan as a percent of GDP. It's an interesting side statistics. But the positive impact from the ECB money printing program has been the fact that immediately the value of the euro went down. It helped all the European exporters, and Europe is very reliant on exports. And ultimately what it did is European exporters started to do much better than before. In the last 12 months, we have seen some solid export growth out of Europe. And these companies have started to hire people again. And in fact, in a number of countries, particularly in Germany, there are shortages of labor, which is now extended also into places like Czech Republic or Hungary. There are no people left, and this is why Angela Merkel wanted all the Syrians to somebody actually had to do the work. All of that, by the way, has really been helpful for European growth, because suddenly that was a positive impact, exports growing, companies hiring again, and companies basically doing well, and consumers going to the shops and beginning to buy. I was with one of our big corporate clients just last week in Switzerland, and they said, Nenad, for 7 years we couldn't raise prices in the European Union. This was the first year that we are able to do so because the consumer is beginning to spend again. That's quite interesting. It's happening. Second positive impact from money printing program is the increase in lending to the private sector. It's happening and it's supporting growth. It's not a cause for major party and a celebration because it's only 2% growth year on year, but it's actually showing signs of solid life across many markets in the Eurozone. And a very important point for government finances. Because the ECB is creating so much demand for government bonds out in the open markets, the yields have come down. So just to give you an example, a small country like Slovenia, which 18 months ago was facing an EU bailout and maybe a threat of an IMF bailout and so on, today is able to raise money at 0.7% because of that development, thanks to the quantitative easing program. And it's basically borrowing money at lower rates than the United States of America today, which means because of this program, many governments in Europe finally, after 7 years of misguided austerity and cutting costs and so forth, have finally come to a space where they can say we can breathe a little easier. We don't have to be obsessed with austerity anymore like we have been in the last 7 years or so. And they can spend a little bit more finally and maybe provide more of the public services that have been missing and the people have been complaining about deterioration of services and so on. It's not an overwhelming trend, but at least it's something that's supporting growth. Now, all of this is beneficial, and at the moment, European Union is growing 1.5% approximately, and effectively, we are probably going to see very similar growth rate also next year, because some of the Trump policies, by the way, will also be beneficial, in my view, for some of the European countries as well. Now, going over the Atlantic to the United States, the Trump presidency, what does it mean? First of all, initial days, everybody was scratching their head. He changed his views about everything multiple times. The biggest example of changing the views was changing a view on abortion in 7.5 hours, 3 times, depending on the audience who was in the room. He changed his view on how to fight the Islamic State 16 times, completely opposite views, and so on. On taxation, income tax and corporate tax, 9 times change of view, from I should pay more to everybody should pay more, I don't know what I think, all of that kind of stuff. Finally, things became a little clear, and I'm here hypothesizing if you want, but this is my best assumption that I will give you. When I saw who was appointed the Chief of Staff of the White House, then it became clear where the policies are very likely to go. Reince Priebus is the chairman of the Republican Party. So he's not just some small guy who came in to hug Donald Trump on stage when he won. He is the chairman of the party. He supported him during the campaign, particularly in the last weeks and months. And in fact, I think the biggest clues and guidance of what is likely to happen with the American economic and foreign policy are sitting in a document called the Republican Platform 2016. It's sitting on their website. You can read it on the plane. It's not so long, 66 pages. And it tells you a number of things. It tells you that there will be some significant tax cuts for corporations and income tax. There'll be some investments in infrastructure, but mostly through public-private partnerships, not necessarily federal money. It tells you that US doesn't want to be dependent on anybody else for energy. They will be opening up federal lands for oil and gas exploration and offshore and so on. They are talking still about being pro-trade, which is a little bit clashing with Trump. But only if we stick with 2 of these policies and say tax cuts will happen and some infrastructure spending will happen, and you see the reaction of the markets based on that. The reaction of the market is, in the short term, these policies will be great for US growth. It will be like an injection of growth, of some drug into your bloodstream. Effectively, what it will do already in 2017 and 18, it will push US growth much faster in the very short term. And that means the Federal Reserve will have no choice but to raise interest rates already in December. And the likelihood of an interest rate that the interest rates will rise already in December has now gone to 100%. And there will be more interest rate increases also in 2017. This guarantees the ultra-strong US dollar. So if you're coming from any of the markets in the developing world in particular, where your country has sizable dollar debts, like Turkey, for example, or Russia, you can bet there'll be harder times ahead because the governments will be not able to service their installments on the sizable debts that they have taken in foreign currencies, in particularly the US dollar. So that's an implication, for example, a negative one. On the other side, because this dollar will be so strong and the euro will remain weak, good news for European exporters again. They'll be able to boost their sales to the Middle East, where currencies are pegged to the dollar, to many other markets where the dollar pegs are taking place, to the US itself. And it should actually provide some also short-term boost to Western Europe, Central European markets as well. And if infrastructure developments happen as well, that's good news for commodity markets. Commodity traders will start betting that metals prices will rise and energy prices, and in fact, that will be beneficial maybe for some of the markets in Africa and Latin America that are dependent on those. Later on, of course, it all gets very murky and fuzzy because after initial boost of growth that the tax cuts will provide, later on it means major, significant increase in budget deficit, government debt, and so on, and that will have some implications for growth later on, probably as of 2019 for the United States. So that document that the Republican Party has been preparing and working on for a long time, I think gives us probably the closest thing to what is very likely to happen with the US economic and also foreign policies, and I'm not going into foreign policies at this meeting at all. So to conclude with all of this, as you can see, we live in a very unusual, crazy world, if you think about it, where volatility, particularly in developing markets, will be ongoing. These massive inflows and outflows will be happening in the future, and it will cause significant difficulties for governments from time to time. In Europe, all these money printing programs, and in the United States, which is now abandoned, but also its ongoing money printing program in Japan, this will provide relatively easy access to governments to financing at cheap as well. So for these developed markets, at least access to finance for government services should be, in fact, much better than for many developing markets as we speak, particularly, I would say, in the short term. In the end, I think all governments in the world will have no choice in the future but to look very carefully how they manage public money, how do we improve productivity, how do we design some of the best business practices from the corporate world and apply it on government in terms of having, I don't know, joint purchasing department that buys everything for the government and only one department out there rather than multiple departments from different ministries. Can we restructure our government ministries and agencies and so on to avoid any overlaps and cut costs on that side? How are we connecting with the citizens? Are we able to actually listen to what they actually need? Can we be more proactive as governments as well and engage them more and so on? These are some of the things that governments will be able, and especially using the technology that is improving so much, to be able to kind of put together and instead of being reactive to the citizens' needs, to be much more proactive and in fact consolidate everything under one big umbrella that will be servicing citizens across these markets. So I'll stop here and take any questions that you might have on any of these markets or any of the issues that I've raised here. Thank you so much. Thank you.
Okay, thank you very much, Nenad. Absolutely fascinating. Could we have questions from the floor and or the panel at the front? Please give your name when you ask your question. I can kick off with one. Some of the stuff that you were talking about, Nenad, in relation to the sort of freedom of movement of capital in government finance also relates to the ease with which corporations can move their money around the world, which necessarily has an impact on the ability of governments to provide funding for public services. What are your thoughts about the sort of movement towards the profit-shifting proposals from OECD, and are we likely to see an improvement in the kind of base erosion and profit-shifting problem as the G20 at least starts to tighten up on that?
I have to say I'm skeptical about some of those plans that will capture all of the profits in a way that ultimately should be paid as taxes in various jurisdictions around Europe and in many countries around the world. As you know, many large corporations are consolidating earnings usually in locations that are the lowest tax havens, if you want to call it that, through various accounting tricks, as we all know. And that, I think, is a major source in terms of the lack of finance for governments at the end of the day, because if certain service and something is done and sold in a certain country and no tax actually stays in that particular place, needless to say, year after year, governments are having a problem with this. And the lack of financing is there, budget deficits. If all the companies would be paying what they should be paying, then many countries around the world wouldn't even have that issue of budget deficits at all. So I have no idea where that will be going and whether anybody will seriously start to question some of those practices. I think it's more of a topic for some global tax consultant, and I'm not one.
Yes, sir.
Paul Stafford from the Court of Auditors. With Brexit, and also Mr. Trump and the potential to renegotiate or tear up agreements like the North American FTA, do you see the potential tendency to reintroduce tariffs to reverse the trend of the last 50 years of abolishing tariffs to be a threat to the global economy?
Excellent question. I think it is a threat at the moment, because the threats highlighted by Donald Trump during the campaign are quite significant, talking about, for example, 45% import tariff on anything coming into the United States of America from China, dismantling NAFTA agreement completely, and so on. There will be probably an element of new protectionism creeping up. I don't think he will be doing exactly what he said during the campaign. Somebody would need to remind him, for example, that if he would start a trade war with China, many US companies would suffer. In fact, China is the third largest market for US exports on the planet Earth. And many companies would suffer immediately overnight, and China already said officially as well, we would retaliate if you do something like this against us. And also somebody should be reminding Donald Trump as well that China is the largest holder of US government debt on the planet Earth as well. And if they would be immediately overnight deciding to dump all of that debt into the global markets, they could cause significant problems for the US economy and also to global environment as well. Dismantling NAFTA as well would not be that easy either, because most of the Republicans, and they now control the Senate and the Congress, and most of the Democrats as well, in fact, are pro-trade, including his Vice President, Mike Pence, as well. He is very pro-trade, and he's voted for all the trade agreements when he was in the Congress for a long time. And in fact, what we might see probably is some sort of specific, sporadic counter-trade measures, some import duties, tariffs imposed on certain industries, accusing maybe, I don't know, some Chinese steel plant of dumping prices and so on, then raising tariffs on a specific product for a specific period of time, rather than some blanket protectionism, which would also hurt the United States in this particular case. I'm also a little skeptical about his announcement that on his day one he would dismantle the Trans-Pacific Partnership as well, because Trans-Pacific Partnership is not only about trade, it is about geopolitical influence of the United States in Asia, and that influence, of course, the United States will want to keep, and they will not want China to step into the void with its own version of the Transatlantic Partnership. And again, I doubt that this would happen, and I doubt that it would happen so quickly. But some renegotiations of certain deals is certainly possible, that they might step and say, okay, let's renegotiate some of the clauses in the TPP, let's renegotiate some of the clauses in the trade agreement with Europe, which is also pending and for a long time as well. And even the Mexican president has said NAFTA was negotiated back in the late 80s, early 90s, signed in 1994. Certainly parts of that agreement could be improved. And let's sit down and talk how we can actually make it work better for both sides. So some form of renegotiations of certain deals and sporadic protectionism is what I would expect at this stage. These big threats, I doubt they would go through the Congress or the Senate, or in fact anywhere in the major establishments or governments, authorities around the world.
Michael Bain, also from the Court of Auditors. When you talked about the quantitative easing and the printing of money, you were critical, and also on some other areas, and you said that nobody was watching and nobody was regulating. A lot of us work in government finance and financial control. Who do you think should have been regulating, given that it's central banks and governments who are taking these decisions?
Just to slightly correct what you just said, I was not critical of quantitative easing. I think it was a good policy, and it still is, because as governments face difficulties and face depressions and recessions, it's actually a good idea to print money temporarily. That's one of the ways you can reflate growth, and Europe couldn't do that for a long time. I was critical about some of that money ending up chasing high yields and going into purely speculative financial casino gambling, and that causing difficulties around the world. That's where I was talking about. And the fact that it is allowed to do so, that anybody can start trading any of the commodities around the world or any of the government paper or treasury bills, and there are no countries are basically imposing any capital controls. where usually these types of agreements on capital controls, they don't tend to be multilateral as far as I can see, but governments can introduce them unilaterally as their own decision, like China was doing, or during the 1990s, for example, when we had a crisis in Latin America. Also, we had Chile with capital controls and didn't have any crisis during that time. So usually countries, when they have capital controls in place, they tend to be more resilient, and they don't get the speculative inflow first and then the speculative outflow, and then it's much easier to run economic policy, just as Europe was able to do 50 years after the Second World War.
Alan Edwards, I work for CIPFA, and that was a great tour de force. I particularly like the fact that we got movie recommendations in the middle of it as well as economic analysis. That was great. The only country you did mention is the little island off the mainland of Europe, and given the sort of dominance of the Brexit debate, of course, for those of us from the UK, how does it look from a European perspective, the impact of Brexit on the economy in terms of UK, but also potentially Europe?
Honestly, I don't think anybody really knows what Brexit means. I think it's still a very open question. I don't think there is full understanding even within the British government, or for that matter, any European governments that are struggling to understand what Boris Johnson is telling them when he visits Brussels or any other cities. In fact, there's been a lot of verbal clashes already taking place in the last weeks in particular, and total disagreements where this might be heading. So the uncertainty of that, I think what it means for the British economy is the following. Britain runs one of the sizable current account deficits on the planet Earth. It tends to import much more than export in general. That gap needs to be financed with something. And theoretically, one can cover the gap by some money printing, which obviously the central bank partly is doing. But usually you would have to attract some capital in order to keep the value of the pound where it is today. And considering that businesses have no idea where this is going, there is no visibility on tariffs in 2 or 3 or 4 years' time. Nobody knows. Also, some of the large portfolio investors who are buying various government bonds and so on might be questioning, is this the right time and a good time to buy any British government paper? I don't know. So if the capital doesn't come in, it basically means the pound today, as we speak, is still very overvalued, and it should be falling much more from where we are today if the capital doesn't come in. If the capital comes in, that's fine, and it will obviously pay for that. Obviously, even Mr. Hammond the other day basically said we are facing slower growth, we are facing bigger budget deficits, greater need to borrow from international markets, and when that happens, the question will be, will the markets buy the government paper? And if they don't, the pound will continue to slide until it finds its real equilibrium, which would be closer to the, let's say, export and import equation. So a lot of uncertainty. I still believe that down the road they will find some kind of compromise, that there will be some form of trade agreements, maybe bilateral or even with a whole group, which might impose, let's say, small import duties, so to please this European establishment on one side, but also to allow access for European products into the UK without major import duties and restrictions and so on. So I'm still hopeful that some form of an agreement will be there. I'm more worried, by the way, about more Brexits or Frexits or countries leaving the Eurozone itself. And Euro, as we all know, has not been particularly well designed. Too early introduced, without political fiscal union, without proper design. It's certainly something that I'm watching very carefully, whether it will stay in the next 5 or 7 years. If we get far left, far right voted in certain markets, will the euro stay? Will some other countries decide to leave first the Eurozone and then maybe European Union itself at some stage? We are certainly entering a tricky period, I think, for the European Union. At the moment, it's doing well on the back of this quantitative easing, but I think political, social pressures are quite significant at the moment.
Got a question from Ian Ball.
Thanks. So I registered your comment about the value of quantitative easing and the desirability of printing money temporarily. My question was, how long is temporarily? And what do you identified some of the benefits of that, but what are the disadvantages associated with quantitative easing?
Oh, excellent question. And temporary, what is temporary? It's a good one, because we have to remember this was the biggest economic crisis in 80 years. And without quantitative easing, the alternative was pretty much doing nothing. And that would have landed us again very much in not a recession, but a depression that would be going on for quite some time, in my view. Because if you remember some of the initial graphs showing US economic decline in 2009, and then unemployment rate starting to go up in 2009. And if you put charts from 1929 against this, what was happening in 2009, the charts were exactly the same. So the beginning of the crisis looked like the beginning of the Great Depression. And so there was no real alternative but to provide a monetary stimulus which will then translate immediately into a fiscal stimulus. And we all know that it worked in terms of economic growth and so on. The downside of that, of course, is that it can create asset bubbles if it goes on for too long. And what is temporary, again, your question, usually at the moment you see entrenched economic growth and you look at the inflation rate and unemployment as two key indicators. The inflation rate's beginning to rise, unemployment's coming to very low levels. That means it's time to stop. You don't want to keep printing money forever because that can easily lead again to higher inflation, hyperinflationary pressures and so on. This is why the US stopped doing that after 4 years. UK was stopping and then restarting it after the Brexit decision. And Japan is doing it for a very specific reason. They cannot leave the deflationary spiral now for more than 15 years. Prices in Japan are falling. And the only way you can escape the deflationary trap is through printing money. There is no other remedy known to economics. And that's why they're persisting with that all the time, trying to create that extra money supply, literally throwing yen onto the streets of Tokyo, trying to get people to go shopping rather than saving. And it's just a long battle. It's actually very hard to fight the deflation. It's much harder than hyperinflations.